You know, when we think about auditing, we think of certainty, right? Black and white numbers, things that add up perfectly. But what happens when some of the most important figures on a financial statement are really just educated guesses? Today, we're diving into the really tricky world of accounting estimates. This is where auditors have to navigate this fascinating zone of professional judgment and, yeah, a whole lot of uncertainty.
It sounds almost wrong, doesn't it? Educated guesswork. We're taught that accounting is this precise science, but the truth is, some of the biggest numbers on a company's books aren't hard facts at all. They're forecasts. So how on earth can an auditor provide any kind of real assurance on something like that? Well, let's find out.
So, what makes this so incredibly tricky? Well, to really get how an auditor handles this, we first have to understand the fundamental challenge of the estimate itself. It's a unique beast.
Probably the easiest way to wrap your head around this is to think of it like a weather forecast, but for a company's money. An auditor is looking at all the historical data, all the current conditions, and trying to predict a future outcome. You know, like how many warranty claims a car company is going to have to pay out next year. But just like the weather, you can have the best model in the world, but you can never, ever be 100% certain.
Okay, so that's the analogy. But to actually audit something, you need solid rules. You can't just go on a feeling. So let's take a look at how the official auditing standards actually define this whole area of uncertainty.
What you're looking at here is basically the official audit playbook. And I want you to notice the very first step, the one highlighted. Before an auditor can even think about testing anything, they have to completely understand the estimate's DNA. What is it? What's its nature? And how did management come up with that number in the first place?
And here it is, the official definition. It's any dollar amount that's subject to estimation uncertainty. That phrase right there is the key. It's the rulebook itself admitting that, yep, some numbers are just fundamentally unknowable at the time the books are closed.
And this isn't just some abstract theory either. We are talking about huge numbers that can totally change a company's bottom line. How much a car maker thinks it's going to spend on future warranties, how many loans a bank expects will go bad, or the potential hit from a massive lawsuit. These are not rounding errors. These are giant judgments about a future that hasn't happened yet.
Which, of course, brings us right back to the central problem here. If these critical numbers are essentially just sophisticated guesses, how can an auditor, and by extension us, have any trust or confidence in them at all? How do you audit a forecast?
Well, the answer is, you do it with a very clear game plan. Auditors don't just throw up their hands and guess along with the company. They follow a specific, methodical set of procedures designed to tackle that uncertainty head-on. So, if we look back at that playbook, you'll see the next big step, audit procedures. We've moved from understanding what the estimate is to figuring out how to deal with it. This is the auditor's structured approach to getting comfortable with the company's forecast.
And really, this whole approach boils down to 3 key steps. First, they plan their attack. Second, and this is the really critical part, they assess the degree of uncertainty. Is this a pretty simple guess or a super complex one? And third, based on that assessment, they respond with very specific actions.
That assessment phase is absolutely key, because not all estimates are created equal. An auditor's first job is to separate the simple, routine stuff from the truly high-risk judgments that are going to need a much, much closer look.
And the difference between them is just stark. I mean, on one hand, you've got low uncertainty items like calculating the depreciation on an office computer. It's routine, it's formulaic. But on the other hand, you have these high uncertainty estimates like trying to predict the outcome of a lawsuit. These require a ton of judgment and are incredibly sensitive. A tiny change in one of your assumptions can have a massive impact on the final number.
So once an auditor flags an estimate as high risk, what's the response? What do? This is where they really get their hands dirty. It's the most active phase of the entire process.
Auditors basically deploy a whole toolkit of responses. They can dig in and test how management made the estimate, asking things like, are your assumptions sound? Is your data reliable? They might even develop their own independent estimate from scratch, just to see if it's in the same ballpark. And crucially, they also look for clues from events that happen after the year is ended but before the final report is signed. And of course, they test the company's internal controls to make sure the whole process is solid from the get-go.
And this, right here, is probably the most important thing to understand. The auditor's goal is not to be a fortune teller. It's not to find the one single perfect number. Their job is to audit the process. Was management's method reasonable? Was it well controlled? Was it based on the best available evidence at the time? They're auditing the judgment, not the unknowable future.
This all leads to a really fascinating final question.
As AI gets better and better at making these complex predictions, what happens to the human auditor? If the estimate comes from a sophisticated algorithm, does the auditor's job shift from auditing a person's judgment to auditing the code itself? It's a huge question and one that's going to shape the future of the entire profession. Thanks for joining me.